Hello, and thanks for joining me for this continued discussion on the stock market and whether we think it's overvalued and whether we think that's supported or not, and what the future holds and what risk lays ahead. So today, what we're talking about is why expensive markets can stay expensive, and this is kind of in a series of 6 videos. This is video number 3. Today, we're going to talk about liquidity and macro data, and we've established in our first 2 videos that the market is expensive, that it is overvalued. But is that appropriate for right now? And the next 4 videos are going to answer that question. We're starting with liquidity. And first, to go back to the question that was presented on the opening slide is, can markets stay, or why markets stay expensive? And they can for a long time when liquidity remains high. Investors are optimistic, earnings are growing, large amounts of capital flowing into the markets. Those 4 things can keep the stock market elevated for a long time. So really what we're going to be looking at is, are any of these 4 things changing? Because if they are, then that means that the stock market value may start to change as well. And today we're really focusing on the first bullet. So liquidity, how available money is to move through the economy. That's kind of the definition. It's similar to your personal finance when you say how liquid are you, how much money do you have in cash, how much money is available to spend. Similar to that, only more on a larger economy basis. So what drives liquidity? One is interest rates. It's a big driver, but not the only factor. Money supply, leverage, government spending, lending activity, all influence liquidity. And the Federal Reserve policies are a great influencer on liquidity. So why does it matter? When liquidity is high, people's risk appetite is high, and stock prices go up. Of course, liquidity is, as we were saying earlier, is influenced by interest rates. So when interest rates are low, there's more money available for people to borrow and buy things like cars and houses, and businesses could buy tractors and invest in building new factories. And that all drives the economy. It helps the earnings of those car makers and those tractor makers, as you would expect. And that will drive the stock market up. But if liquidity dries up, or one of the main things that drive that is interest rates. If interest rates go up, then all of that happens in reverse, and there's less purchasing power and less fuel in the economy, if you will. So, as we were saying, the Federal Reserve influences liquidity greatly. And so what we are looking at here is the Federal Reserve balance sheet. So the Federal Reserve can inject liquidity into the market by purchasing, or into the economy, I should say, by purchasing U.S. Treasury bonds, mortgage-backed securities, other assets. And this became especially important in 2008 financial crisis, as well as the COVID crash. So you can see on the graph, they started to put more money into the system in 2008, and then it took off right before or during the COVID crisis. So let's look at the 2008 financial crisis. During that time, the Federal Reserve lowered rates aggressively and launched quantitative easing. And the Fed purchased large amounts of assets to stabilize the market and support liquidity. And you can see that with a little blip in 2008, and then a continued increase for some time. And then in COVID, it was a surge. So during COVID, both fiscal policy and monetary policy expanded aggressively at the same time. It was like fuel for the economy, which was needed because so much was shut down. So governments issued stimulus checks and large support programs, while the Federal Reserve lowered rates and injected massive liquidity into the financial system. And that's what we see here in their balance sheet. So that's what this slide represents. And this liquidity, or the Federal Reserve balance sheet, drives what money is available. So this next graph here is money supply. And so that includes, it's a combination of things like cash, checking deposits, savings accounts, and other high liquid forms of money. So it's what's available for the consumers to spend and businesses to spend. So modern banking systems create money through lending. When a bank makes loans, the new deposits are effectively created, and more lending can lead to more deposits, higher money supply, which we call M2, and stronger liquidity conditions. So the Federal Reserve's behavior on the prior slide drove money supply into the economy, and this money was is oftentimes spent, and so that allows us to buy things and drive up earnings, which drives up the stock price. So for historical context, liquidity and money supply are still very high. It's like we gained a lot of weight over the last 15 to 20 years. Let's say we put on 100 pounds of weight, but then in the last little bit, we lost 15 pounds, but we're still super fat. That's what those graphs were showing us. You did see, let me go back to the graphs. You did see a pullback when inflation went up a couple of years ago in 2022. You did see a pullback in both money supply and Federal Reserve balance sheet. And as a result, we did see that the stock market went down in 2022. I think it was between, depending on the indices is between 9 and 18% that the stock market went down. But then, of course, it continued its run after that. So money supplies are still high. And this is just explaining how that has helped support the high value of the stock market. Historically, high liquidity and money supply are keeping the stock market high. So I'm calling this stoplight indicator green because it's still historically high. What does that mean? Should you buy or sell? Well, on its own, it doesn't mean either, but it means to keep an eye on inflation, because when inflation goes up, interest rates typically go up to try to slow the inflation, and then liquidity goes down and stock prices go down for all the reasons we just discussed. So recently, you've seen in the latest inflation reports that inflation is climbing. We also saw that Treasury yields went up a little bit, so interest rates went up a little bit today, and lo and behold, the stock market went down, most indices by over 1%. So this happens fast. So when you're trying to answer the question, what does this mean? Should I buy or should I sell? I think the answer to that question is, what do you think is going to happen to inflation? What do you think is going to happen to interest rates? You know, is the influence that Trump's having on the Federal Reserve going to mean that they're less likely to raise interest rates in response to inflation? Maybe. Is that good or is that bad? It might delay the pain, but the pain is coming if the inflation, if you can't control it and it gets out of control. You know, of course, that'll impact all of our ability to buy things, and that will hurt the economy even more in the long run. So here's our summary. Signal strength, yellow. The CAPE index yellow, Buffett indicator red. The market is clearly overvalued. Liquidity is helping prop that up, so that we're giving that a green, but it's something to keep a close eye on because that can change rather quickly. So we're going to be tracking that closely. So the next thing we're going to look at, the next three things we're going to look at to determine whether these things are also holding up the market, and if they change quickly, what's going on. Of course, inflation we just talked about. We're just going to dive deeper into it and look at what it's been doing historically, what we think it might happen in the future. Same with unemployment. We'll also look at the timing of upcoming reports on those two things and when they might influence the markets based on upcoming news. And we'll also look at sentiment and margin debt, and we'll add it all together and make a scorecard. And then we'll quantify each component of that scorecard. And with that, we think that'll help us make better decisions or understand our risk more around the market. So stay tuned as we continue to put this together. I think it's now starting to get interesting. And for the first time, I added this sentence, and we're going to start to make predictions about what can happen next, or what triggers might topple this whole thing. Thanks a lot. See you next time.